Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Magnera Corporation quarterly report. Magnera Corporation is a global manufacturer of non-woven products that cater to various consumer-oriented end markets. The company's product portfolio includes personal care items such as medical garments, wipes, dryer sheets, and filtration systems. In addition to these, Magnera also offers baby diapers and adult incontinence products. The company's offerings also extend to household essentials like tea bags, coffee filters, and cable wrap. These diverse products demonstrate the company's ability to adapt to different market needs and provide a wide range of solutions for consumers. With its global presence and headquarters in Charlotte, North Carolina, Magnera Corporation is well-positioned to meet the demands of various markets worldwide. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to drop. The stock price of any company can fluctuate due to various reasons. One major factor is poor financial performance, such as declining revenue or profits. This can be caused by internal issues like inefficient management, high operational costs, or external factors like changes in market demand or competition. Another reason for a decline in stock price is negative news and publicity surrounding the company. This can include scandals, product recalls, or other controversies that damage the company's reputation and erode investor confidence. Additionally, economic downturns or industry-wide trends can also impact a company's stock price. If the overall market is experiencing a downturn, investors may become risk-averse and sell their shares, causing prices to drop. Lastly, regulatory issues or changes in government policies can also affect a company's stock price. For instance, if new regulations are introduced that increase costs for the company, its stock price may decline as investors factor in these additional expenses. In conclusion, there are several reasons why a stock price might drop. Understanding these factors is essential for making informed investment decisions and mitigating potential losses. Magnera Corporation maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Magnera Corporation trades at a higher price-to-book ratio of 0.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 84% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified by examining the performance of specific business segments. In this case, the Americas segment and the Rest of World segment have shown increases in net sales. The Americas segment experienced a $20 increase from $420 to $440. While the Rest of World segment saw a more significant increase of $70 from $282 to $352. These results indicate that revenue growth is being driven by these two segments, but it remains unclear what specific factors are contributing to this growth or whether other segments may be experiencing declines in revenue. Net income decline. A shift in profitability. The company's net income experienced a significant decline from $69 million to $29 million. This reduction in profitability is a notable trend that warrants examination. Despite this downturn, certain segments of the business demonstrated improved profit margins. Profit margins show resilience. Interestingly, the Americas segment and Rest of World segment saw increases in adjusted EBITDA margins, rising from 13.3% to 13.6% and 9.9% to 10%, respectively. These gains suggest that specific regions within the company are adapting well to market conditions. Net income margin decline. However, the total company's net income margin declined from -9.8% to -3.7%. This decrease in profitability is a concerning trend that requires further investigation. The report attributes the decline in revenue to general market softness in Europe and decreased selling prices, but does not provide explicit reasons for the change in net income and profit margins. The company's financial performance has shown significant improvement in terms of generating positive operating cash flow. According to recent data, the company produced $2 million in cash from operating activities during the current quarter, marking a stark contrast to the previous year, when it reported a negative figure. This shift towards positive operating cash flow is a testament to the company's ability to manage its finances effectively and generate revenue. The company's debt level and interest expenses have undergone some notable changes. A closer look at the data reveals that long-term debt has actually decreased from $1,952 to $1,931 over a certain period. This reduction in debt is a positive sign for the company's financial health. However, despite this decrease in debt, the interest expense net remains unchanged at $2. This suggests that while the company may have reduced its overall debt burden, it has not seen any significant savings on interest payments. Overall, these changes indicate some stability and control over the company's finances, but also highlight areas where further improvement is needed. The performance of various segments and regions was a mixed bag for the company. In terms of geographic performance, the Americas region stood out as a clear winner, with both net sales and adjusted EBITDA increasing significantly from the previous quarter. The Rest of World region also showed improvement, but at a slower rate. In terms of business segments, the consumer products segment generated revenue, although specific figures were not provided. Similarly, the industrial materials segment also generated revenue, but again, no specific numbers were given. Overall, it appears that the Americas region was the strongest performer, with both net sales and adjusted EBITDA increasing significantly. The Rest of World region showed improvement, but at a slower rate than the Americas. Management is signaling a focus on cost reduction and efficiency through Project Core, which aims to rationalize plants across all segments over the next 2 fiscal years. This initiative is part of the company's efforts to adapt to changing market conditions. The company has also acknowledged a decline in revenue due to lower sales in key regions, such as Europe and North America. However, this decrease was partially offset by a positive cash flow trend, with $2 million generated from operating activities during the quarter. This suggests that while the company is facing challenges, it remains financially stable. That concludes the financial summary for Magnera Corporation. Feel free to comment below, and I will be happy to answer them when possible.